Hello everyone, this channel is from Japan to the world. I will be reporting about Japan, the world from Japan's point of view, economy, politics, and culture. If you want to do business in Japan, please visit this channel. Here is today's content. The all-country World Equity Index in the new NISA needs to be alchemy. In Japan, the all-country World Equity Index is gaining popularity as a target for the new NISA, a tax break on profits for individuals starting in 2024. In the all-country World Equity Index, U.S. equities are 50 to 70%. Japanese equities approximately 10%. The weight is proportional to the market capitalization of the stock. Looking at eMAXI3 All-Country World Equity, a popular mutual fund in the All-Country World Equity Index. It has risen smoothly from 8,320 yen to 24,737 yen in 4 years from 2020 after COVID-19 started. A tripling in 4 years is a high annual increase of 31.6%. This factor results from the massive increase in money after COVID-19, which can be called a financial or easing market. In the dollar-based all-country world equity index, there is a foreign exchange gain when the yen weakens, but a foreign exchange loss when the yen appreciates in the opposite direction. A 40% depreciation of the yen against the dollar in the 2022 index will look like a 40% appreciation in the dollar-based all-country world equity index. If the yen were to reach 120 to the dollar in 2025, a 29% appreciation of the yen, the index would decline 29% in yen terms. Modern portfolio theory. The All-Country World Equity Index is an ETF structured according to the modern portfolio theory, which is the only scientific method available. Modern portfolio theory was developed by Harry Markowitz, who won the Nobel Prize in 1919. Let's take a quick look at modern portfolio theory. Have you heard the saying, "Don't put all your eggs in one basket"? To see if this is really true, consider the following game. It is roulette game that has a 50% chance of coming out red or black, and the cost of the game is 400,000 yen per game. If the roulette game is successful, the prize is 1 million yen, but it is not successful, the prize is 0 yen. The expected return on the entry fee is 50%. 1 million yen divided by 400,000 yen. However, it is definitely high risk in the sense that there is a 50% chance of losing 400,000 yen. The risk standard deviation is calculated as 155%. The standard deviation is difference from the mean. So, let us propose the following proposition. If you win, you will lose 50% of your winnings. If you win, the prize money is halved to 500,000 yen. In return, if you halve the entry fee to 200,000 yen, you will play twice. That is very fair. The organizer of the game would be willing to accept it. However, this deal allows you to significantly reduce the risk without changing the return. The probability of winning 2 times in a row and getting 1 million yen, and the probability of missing 2 times in a row and losing all your money are reached 55%. On the other hand, the probability of winning once and getting 100,000 yen is 50%. Calculating risk and return on this basis, the expected return remains at 55%, but only the risk drops to 88.4%. Since the original risk of roulette is 155%, this is a significant reduction in risk. Now, what happens if we ask the player to pay 100,000 yen per game and 250,000 yen in winnings and increase the number of games to 4? The expected return remains the same at 55%, but the risk drops to 62.5%. As you can see from the above, if you divided your money into smaller portions and bet on as many games as possible, you can keep the expected return at 25% and reduce the risk to the limit. If such a roulette game exists, you can increase your wealth by 1.25 times by finally diversifying all your assets. The risk reduction effect of diversification is proportional to the square root of the number of times diversified. This is the diversification effect, the first conclusion of the modern portfolio theory of Nobel Prize winning economist Harry Markowitz. In other words, investors can reduce the risks of their portfolio by having multiple assets. In other words, diversification provides a more reliable expected return. According to Markowitz, people are risk averse. For the same return, we should choose lower risk investments. Therefore, investors should put their eggs in more than one basket. Markowitz concludes. Next, let's look at the second pillar of modern portfolio theory, the correlation effect. For the risk reduction effect of diversification to hold, there is a crucial assumption, that is, the price movements of each asset must be independent, i.e., they must not influence each other. Even if you play a game of roulette twice, the result of each game should not affect each other. Just because you get red in the first game does not mean that you will always get black in the second game. They are completely independent. It is a random walk world. In the real world, however, the movements of different investment instruments are closely related. For example, the relationship between the dollar-yen exchange rate and export-related stocks is one such example. When the dollar appreciates and the yen depreciates, the stock prices of automakers that make money from export rise. This is because the yen value of overseas sales rises dramatically as a result of the weaker yen. Conversely, when the dollar appreciates, the yen depreciates, the stock price of importing companies such as oil companies tend to fall. This is because the cost of purchasing raw materials becomes higher and profitability deteriorates. At present, we saw that there is positive correlation between the dollar-yen exchange rate and the stock price movements of exporting companies, while there is a negative correlation between the dollar-yen exchange rate and the stock price movements of importing companies. In order to reduce risk through diversification, it is necessary not only to have multiple investment targets, but also to consider the correlation between each asset. Modern portfolio theory is a combination of both the diversification effect and the correlation, which was created as a way to reduce risk. However, be careful when buying current dollar mutual funds portfolios. The All-Country World Equity Index is one such example. This is because even if the expected annual return is 10%, a 10% appreciation of the yen from the current 155 yen per dollar to 114 yen per dollar will result in zero gain. A 20% appreciation of the yen 130 to the dollar would result in a 10% loss, making dollar investment in the NISA a risky investment now that the yen is so weak. If the yen depreciates more than 160 yen, the expected return is 10% plus the foreign exchange gain, but the probability of the yen remaining at 160 yen to the dollar 1 year from now is low. This is because after September 2024, yen interest rates will rise and US interest rates will fall. The government will not take responsibility for investments. You must know that the large amount of dollar investments from the new NISA, the all-country World Equity Index, where most of the money is concentrated, is not a sweep and make money investment. If the yen appreciates, there will be a large number of Japanese who will regret their investments. Finally, it is necessary to consider the investment at one's own risk. Please subscribe to our channel and click the good button. Thank you.